Spot Bitcoin versus Ethereum ETFs, a battle for cryptocurrency supremacy. The burgeoning world of cryptocurrency investing has witnessed a new frontier with the arrival of spot Bitcoin and Ethereum ETFs. These exchange-traded funds offer traditional investors exposure to the volatile, yet potentially lucrative, world of digital assets, without the complexities of direct ownership or trading. However, the choice between Bitcoin and Ethereum ETFs presents a crucial decision for investors, each with its own unique set of risks and rewards. Understanding the underlying assets, Bitcoin versus Ethereum. Before diving into the ETF landscape, it's essential to comprehend the fundamental differences between Bitcoin and Ethereum, the underlying assets these ETFs track. Bitcoin, often hailed as the digital gold, Bitcoin is the pioneer cryptocurrency, known for its limited supply, 21 million, and decentralized nature. Its primary function is as a store of value, attracting investors seeking a hedge against inflation and traditional markets. Ethereum, while sharing some similarities with Bitcoin, Ethereum takes a more multifaceted approach. It operates as a platform for decentralized applications, dApps, ranging from finance to gaming and NFTs. Ethereum's native token, ETH, serves as both a unit of account and a fuel for transactions within the network. Spot versus futures ETFs, navigating the regulatory landscape. Currently, two primary types of cryptocurrency ETFs exist, spot and futures. Understanding the underlying mechanisms is crucial for informed investment decisions. Spot ETFs. These ETFs directly hold the underlying cryptocurrency, aiming to track its price movement as closely as possible. They typically purchase the physical asset from regulated custodians and store it in secure vaults. The recent approval of spot Bitcoin ETFs in the US marks a significant development, offering investors a more straightforward way to gain exposure to Bitcoin. Futures ETFs. These ETFs, which have been available for some time, don't hold the actual cryptocurrency, but rather track its price through futures contracts. These contracts obligate the buyer to purchase the underlying asset at a predetermined price in the future. While offering some advantages like potentially lower fees and increased liquidity, futures ETFs can expose investors to tracking errors and potential contango, where futures prices are higher than the spot price. The showdown, weighing the pros and cons of Bitcoin and Ethereum ETFs. Bitcoin ETFs. Pros. 1. Direct exposure to Bitcoin. Offers a simple and regulated way to gain exposure to Bitcoin, without directly owning or trading it. 2. Potential hedge against inflation. Bitcoin's limited supply and perceived scarcity make it attractive as a potential inflation hedge. 3. Established brand recognition. Bitcoin enjoys widespread recognition and a first-mover advantage in the cryptocurrency market. Cons. 1. High volatility. Bitcoin's price is notoriously volatile, making it a risky investment for some. 2. Limited utility. Bitcoin primarily functions as a store of value, with limited use cases beyond speculation. 3. Regulatory uncertainty. The regulatory landscape surrounding cryptocurrencies remains fluid, potentially impacting Bitcoin's future. Ethereum ETFs. Pros. 1. Exposure to a growing ecosystem. Ethereum's diverse platform and potential for future growth in DeFi, NFTs, and other applications could offer broader investment potential. 2. Potential for higher returns. Ethereum's historical performance has outpaced Bitcoin in some periods, suggesting potentially higher returns. 3. Technological advancements. Ethereum is actively undergoing upgrades, including the upcoming transition to proof of stake, which could improve scalability and energy efficiency. Cons. 1. Complexity and technical challenges. Understanding and navigating the Ethereum ecosystem can be complex for new investors. 2. Competition from other platforms. Ethereum faces competition from other emerging blockchain platforms, potentially impacting its dominance. 3. Regulatory uncertainty for dApps. The regulatory landscape surrounding dApps on the Ethereum network remains unclear, posing potential risks. Making the choice, a tailored approach. Ultimately, the choice between Bitcoin and Ethereum ETFs depends on an individual investor's risk tolerance, investment goals, and overall portfolio strategy. Risk-averse investors. Those seeking a simpler option with established brand recognition and potential inflation hedging might favor Bitcoin ETFs. Tech-savvy investors. Individuals comfortable with navigating a complex ecosystem and open to potentially higher returns may prefer Ethereum ETFs. Diversification. Consider allocating a portion of your portfolio to both Bitcoin and Ethereum ETFs for broader exposure to the cryptocurrency market, while mitigating risks associated with overconcentration. Beyond the binary, emerging trends in crypto ETFs. Multi-asset ETFs. These ETFs provide diversified exposure to a basket of various cryptocurrencies, potentially mitigating the risks associated with individual assets. They cater to investors seeking broader market participation, without the complexities of selecting and managing individual positions. Smart beta strategies. Emerging trends point towards the development of smart beta crypto ETFs that utilize alternative indexing methodologies beyond market capitalization. These could include factors like transaction volume, network activity, or developer engagement, aiming to identify undervalued assets with potential for growth. Active crypto ETFs. Actively managed crypto ETFs are also on the horizon, potentially appealing to investors seeking professional expertise in navigating the volatile market. These ETFs would rely on dedicated fund managers to build and actively adjust portfolios based on market analysis and insights. Environmental considerations. Sustainability is becoming a driving force across industries, and the crypto space is no exception. The emergence of green crypto ETFs focused on energy-efficient blockchain protocols like proof of stake could capture the growing interest in environmentally conscious investments. Regulatory evolution. The regulatory landscape surrounding cryptocurrencies remains fluid, but positive developments are paving the way for wider institutional adoption. Potential regulatory clarity on issues like custody, taxation, and exchange licensing could further solidify the legitimacy and accessibility of crypto ETFs. Global reach. The reach of crypto ETFs is not limited to developed markets. The growing demand for digital asset exposure in emerging economies is prompting the development of regionally focused ETFs cater to specific market dynamics and investor preferences. The future redefined, a fusion of innovation and tradition. While Bitcoin and Ethereum currently occupy the spotlight, the crypto ETF landscape is poised for rapid evolution. New trends, technological advancements, and regulatory adaptations will reshape the investment landscape, offering investors unique opportunities for diversification and exposure to the transformative potential of blockchain technology.